Today, we're diving into the world of setting investment goals. Forget the idea that investing is just throwing your money into the stock market and hoping for the best. It's more like steering a hot air balloon. Takes some skill and planning. Setting clear goals that match what you want and need is where it all begins. But how do you do that without losing your mind or your money? That's what we're here to help you with. In this video, we're sharing practical tips on how to set and reach your investment goals. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. Tip number 1. Know your goals. Before you start investing, you need to know why you're doing it. What are your financial goals? What are you saving or investing for? Do you want to buy a house, pay off debt, retire early, travel the world, or something else? Knowing what matters to you will help you prioritize your goals and focus on the ones that are most important and meaningful to you. As I have mentioned in the previous video, to set effective goals, you can use the SMART acronym, which stands for specific, measurable, achievable, realistic, and time-bound. Tip number 2. Categorize your goals. Once you have your goals listed, you need to categorize them according to their time horizon. How long will it take you to achieve each goal? Generally, you can group your goals into 3 categories: short-term, medium-term, and long-term. Short-term goals are the ones that you want to achieve within a year or less, such as saving for an emergency fund, a vacation, or a wedding. Medium-term goals are the ones that you want to achieve within 5 years or less, such as buying a car, starting a business, or paying for college. Long-term goals are the ones that you want to achieve in more than 5 years, such as buying a house, retiring, or leaving a legacy. Tip number 3. Choose investments that align with your goals. Now that you have your goals categorized, you need to choose the right investments for each category. The main factors that you need to consider are your risk tolerance, your return expectations, and your time horizon. As a general rule, use low risk and high liquidity investments such as savings accounts or money market funds for short-term goals. For medium-term goals, use moderate risk and moderate liquidity investments such as bonds, dividend stocks, or ETFs. For long-term goals, use higher risk and low liquidity investments such as growth stocks, mutual funds, or index funds. Tip number 4. Consider how much you're willing to risk. Another thing that you need to consider when setting your investment goals is how much money you're willing to risk. Investing involves taking risks, and there's no guarantee that you'll make money or even get your money back. Therefore, you need to be prepared for the possibility of losing some or all of your money, and how that would affect your financial situation and your emotional well-being. One way to measure how much you're willing to risk is to use the 4% rule. This rule states that you should not risk more than 4% of your total portfolio on any single investment. This way, you limit your potential loss to only 25% of your portfolio, which is still significant but not devastating. For example, if you have a $100,000 portfolio, you should not risk more than $4,000 on any single investment. Another way to measure how much you're willing to risk is to use the sleep test. This test asks you how much money you can lose without losing sleep. In other words, how much money can you afford to lose without affecting your lifestyle, your goals, or your peace of mind? For example, if you can lose $10,000 without losing sleep, then that's your maximum risk tolerance. Tip number 5. Diversify your portfolio. One of the best ways to reduce your risk and increase your returns is to build a diversified portfolio. This means that you should invest your money in different types of assets such as stocks, bonds, cash, real estate, commodities, etc. This way, you can spread your risk across different markets, sectors, industries, and companies, and reduce the impact of any single investment going bad. Diversification also helps you take advantage of different opportunities and trends in the market. For example, when stocks are going well, you can benefit from their growth and dividends. When bonds are doing well, you can benefit from their stability and interest. When cash is doing well, you can benefit from its liquidity and safety. When real estate is doing well, you can benefit from its appreciation and rental income. When commodities are doing well, you can benefit from their inflation protection and scarcity. To build a diversified portfolio, you can use different strategies such as asset allocation, rebalancing, or dollar cost averaging. Tip number 6. Set up an investment workflow. Setting up an investment workflow is a great way to automate and simplify your investment process. An investment workflow is a plan of action that describes how you save and invest your money and how you monitor and adjust your portfolio. An investment workflow can help you stay on track with your goals, avoid emotional decisions, and save money and time. An investment workflow can vary depending on your personal preferences and circumstances, but a typical one might look something like this. Step number 1. Set up a budget and track your income and expenses. Step number 2. Set up an emergency fund and pay off high interest debt. Step number 3. Set up a retirement account and contribute to it regularly. Step number 4. Set up a brokerage account and invest in a diversified portfolio. Step number 5. Set up a system to monitor and adjust your portfolio. Tip number 7. Determine how much you need to invest. One of the most common questions that investors have is how much they need to invest to achieve their goals. The answer depends on several factors, such as your current savings, your desired income, your expected returns, your time horizon, and your inflation rate. There is no one-size-fits-all formula, but there are some general guidelines that you can use to estimate how much you need to invest. For retirement, a common rule of thumb is to multiply your desired annual income by 25. This is based on the assumption that you can withdraw 4% of your portfolio each year without running out of money. For example, if you want to have $50,000 of income per year in retirement, you need to have $50,000 times 25, which is equal to $1.25 million in your portfolio. Tip number 8. Regularly review your investment goals. The last tip that we have for you is to regularly review your investment goals and make adjustments if needed. Your goals are not set in stone, and they can change over time due to various reasons, such as changes in your income, expenses, lifestyle, preferences, or life events. Therefore, you need to revisit your goals periodically and see if they are still relevant, realistic, and achievable. So, there you have it. These are the 8 tips that we have for you on how to set and achieve your investment goals. Please give this video a thumbs up and share it with your friends who are interested in investing. And don't forget to subscribe to our channel for more finance videos like this one. Thanks for watching, and we'll see you in the next video. Stay financially savvy.